In the shadowy corridors of global finance, where trillion-dollar trades happen in milliseconds and fortunes are made or destroyed with a keystroke, something unusual happened in the silver market. Between late 2024 and early 2025, an anonymous entity quietly accumulated over $650 million worth of physical silver. Not paper contracts, not derivatives, but actual metal. Bars stacked in vaults, coins counted and cataloged, real, tangible wealth in an increasingly digital world. This wasn't a speculative bet by a hedge fund looking for quick returns. This was something different, something deliberate. And in the normally transparent world of commodities trading, where every major move is dissected by analysts within hours, the identity of this buyer remained stubbornly hidden behind layers of corporate structures and intermediary accounts. Silver, often called the poor man's gold, has always lived in the shadow of its more glamorous cousin. While gold captures headlines and central bank attention, silver operates in a strange dual reality, simultaneously an industrial metal critical to modern technology and a monetary asset with thousands of years of history. It's used in solar panels, electronics, medical equipment, and water purification systems, yet it's also hoarded by investors who see it as protection against currency debasement and economic chaos. This duality creates a market far more volatile than gold, with price swings that can devastate the unprepared or enrich those who understand its peculiar dynamics. And in recent months, those dynamics have been shifting in ways that veteran traders find deeply unsettling. The timing of this massive accumulation is particularly significant. The silver market, despite its $1.4 trillion annual trading volume, operates on surprisingly thin physical margins. Unlike gold, where above-ground stocks represent roughly 70 years of mine production, silver's available inventory tells a different story entirely. Industrial consumption devours approximately 60% of annual mine output, leaving far less available for investment demand. When someone steps in to purchase $650 million in physical metal, equivalent to roughly 15 million ounces, it doesn't just create a ripple in the market, it creates a potential supply crisis that reverberates through the entire pricing mechanism. And yet, despite this enormous purchase, silver prices have remained remarkably contained, trading in a narrow range that defies the basic laws of supply and demand. This apparent contradiction raises uncomfortable questions. In a properly functioning market, a purchase of this magnitude should trigger immediate price appreciation as other buyers rush in, fearing they'll miss the move. Sellers should demand premium prices, knowing that significant physical demand has absorbed available supply. Mining companies should announce expansion plans, anticipating higher future prices. But none of this happened. Instead, silver continued trading as if nothing had occurred, its price chart showing the same grinding consolidation pattern that has frustrated investors for months. The disconnect between physical accumulation and paper price suggests something is fundamentally broken in how silver is valued, or that powerful forces are working to ensure prices remain suppressed despite tightening physical availability. The identity of this mysterious buyer matters because it reveals their motivation. If it's a sovereign wealth fund or central bank, it signals a strategic shift in how nations view monetary metals in an era of unprecedented currency creation. If it's a major industrial consumer locking in future supply, it suggests they're seeing something in their order books that terrifies them about silver availability. If it's a billionaire investor or family office, it represents a massive bet that silver's current price represents perhaps the most asymmetric opportunity in commodity markets. Each scenario carries radically different implications for where prices head next and whether this quiet accumulation represents the calm before a violent price storm. Understanding this buyer's identity requires examining the broader context of the silver market in late 2024 and early 2025. Global mine production has been essentially flat for nearly a decade, hovering around 830 million ounces annually. New discoveries have been minimal, with most silver coming as a byproduct of copper, lead, and zinc mining, meaning primary silver production responds sluggishly to price changes. Meanwhile, industrial demand has surged, particularly in solar panel manufacturing, which now consumes over 140 million ounces annually. Electric vehicles, 5G infrastructure, and the broader green energy transition all require silver in quantities that dwarf historical usage. Yet despite this structural deficit, where annual demand exceeds new supply by over 200 million ounces, prices have remained trapped in a range that makes no economic sense.
This is where the story becomes truly fascinating, because it intersects with the equally mysterious world of precious metals price suppression, paper markets that dwarf physical trading by ratios exceeding 250 to 1, and the quiet desperation of bullion banks who've sold metal they may not actually possess. The $650 million purchase didn't happen in isolation. It occurred against a backdrop of declining COMEX-registered silver inventories, persistent premiums in physical markets, and delivery delays that suggest the carefully maintained illusion of abundant supply is beginning to crack. Someone, somewhere, decided that acquiring massive quantities of physical silver at current suppressed prices represented an opportunity too compelling to ignore, and their buying, conducted with obvious care to avoid alerting the broader market, suggests they understand something that most investors have missed.
The mechanics of how someone quietly accumulates $650 million in physical silver reveal as much about the market's structure as the purchase itself. Unlike stocks or bonds that trade electronically with instant settlement, physical precious metals exist in a world of logistical complexity that most modern investors never encounter. Silver bars weigh between 400 and 1,000 troy ounces each, meaning 15 million ounces translates to roughly 15,000 to 37,500 individual bars that must be verified, transported, insured, and stored. This isn't a transaction completed with a wire transfer and a confirmation email. This requires coordination with refineries, vaults, armored transport companies, and a network of dealers capable of sourcing metal without triggering market-moving rumors. The fact that this accumulation occurred without significant price impact suggests the buyer possessed both sophisticated market knowledge and relationships deep enough to bypass normal retail channels entirely. The global silver supply chain operates through a surprisingly small number of choke points. Major refineries in Switzerland, the United States, and Canada process the vast majority of investment-grade silver, transforming doré bars from mines into the standardized products demanded by institutional buyers. These refineries maintain waiting lists that, as of late 2024, stretched to 6 weeks or longer for large orders, a clear signal that physical demand was already straining production capacity. For our mystery buyer to acquire $650 million worth of metal, they likely needed to secure supply agreements months in advance, possibly purchasing silver directly from miners before it even reached refineries, or tapping into existing stockpiles held by banks and dealers. Either approach requires financial muscle and industry connections that eliminate casual investors from consideration. The London Bullion Market Association, which sets the standards for good delivery silver bars traded internationally, reported something peculiar in their vault holdings data during this period. While total silver inventories appeared stable on paper, the composition shifted dramatically. Allocated silver, metal assigned to specific owners who paid storage fees but couldn't immediately access their holdings, remained relatively constant. But unallocated silver, the pool of metal that dealers use to settle trades and meet delivery obligations, declined precipitously. This matters because unallocated silver functions like fractional reserve banking. The same physical bars back multiple paper claims, operating smoothly only as long as most owners never demand actual delivery. When someone removes large quantities of unallocated silver into allocated storage or physical possession, it exposes the uncomfortable reality that far more claims exist than metal to satisfy them. The timing coincided with other significant developments in precious metals markets that suggested a coordinated reassessment of counterparty risk. Several European pension funds announced quiet shifts in their precious metals holdings, moving from paper claims backed by bank promises to physical metals stored in segregated vaults. Asian buyers, particularly from India and China, increased premiums they were willing to pay for immediate delivery rather than waiting for standard settlement periods. The spread between London spot prices and Shanghai gold and silver prices widened to levels not seen since the pandemic disruptions of 2020, indicating that metal wasn't flowing freely between markets as efficient arbitrage would demand. These weren't isolated incidents, but symptoms of a broader loss of confidence in the paper promises that have dominated precious metals trading for decades. Consider the COMEX, the primary futures exchange where silver prices are discovered and where the vast majority of trading volume occurs. On an average day, contracts represent 500 to 800 million ounces of silver change hands, more metal than exists in all registered COMEX vaults combined. This works because futures trading operates on the assumption that contracts will be rolled forward or settled in cash rather than metal. Actual delivery requests represent less than 2% of open interest in normal circumstances. But what happens when a significant buyer decides they want physical delivery instead of paper profits? The system doesn't break immediately. It has circuit breakers and force majeure clauses and the ability to settle in cash if metal isn't available. But it does expose the essential fiction at the heart of modern commodity markets.
that prices determined by paper trading in New York accurately reflect the availability of physical metal in the real world. Our mystery buyer strategy of acquiring physical metal rather than futures positions or ETF shares suggests they understood this distinction perfectly. Exchange-traded funds like SLV, which hold over 500 million ounces in trust for shareholders, provide price exposure without the hassle of storage and insurance, but fund shares represent beneficial ownership, not direct claims on specific bars. The fine print in these prospectus documents contain language about potential delivery delays, possible substitution of metal, and limitations on redemption rights that become extremely relevant when markets experience stress. Similarly, futures contracts settled in cash rather than metal offer price exposure, but eliminate the insurance value that comes from holding physical assets outside the banking system. Someone spending $650 million on actual bars clearly prioritized security and tangible ownership over convenience and liquidity. The purchase also occurred against a backdrop of declining silver mining economics that threatens future supply. At current prices hovering around $24 to $26 per ounce, many primary silver mines operate at marginal profitability or outright losses. All-in sustaining costs for pure silver producers average $18 to $22 per ounce, leaving minimal margins for the capital investment required to discover and develop new deposits. The lack of price incentive has led to a decade-long drought in major silver discoveries. Most exploration budgets now focus on gold, copper, or battery metals with stronger price trajectories. This creates a dangerous situation where industrial demand continues growing while the supply response remains muted, setting up potential shortages that could send prices vertical when the market finally acknowledges the deficit. A sophisticated buyer accumulating physical metal today might be positioning for exactly this scenario, acquiring supply at suppressed prices before scarcity forces a repricing. The question of price suppression in precious metals markets, once dismissed as conspiracy theory, has gained uncomfortable credibility through multiple legal settlements and regulatory investigations. Deutsche Bank, UBS, HSBC, and other major bullion banks paid hundreds of millions in fines for manipulating gold and silver prices through spoofing, placing large orders they intended to cancel to create false impressions of market demand. These weren't isolated incidents by rogue traders, but systematic practices that persisted for years across multiple institutions. If prices can be manipulated downward through paper trading, then someone with knowledge of these practices might view the current silver market as offering metal at artificially depressed levels, a gift from those foolish enough to sell physical assets for paper profits.
The profile of potential buyers capable of executing a $650 million physical silver acquisition narrows considerably when examined through the lens of motivation, capability, and market access. Retail investors, even wealthy ones, typically lack the infrastructure and relationships necessary to source and store this quantity of metal discreetly. Mining companies already possess silver exposure through their reserves and wouldn't need to purchase additional metal unless hedging complex derivative positions. That leaves three primary categories of sophisticated actors: sovereign wealth funds and central banks repositioning monetary reserves, industrial conglomerates securing critical supply chains, or ultra-high net worth individuals and family offices making concentrated bets on monetary chaos. Each possibility carries distinct implications for market structure and future price trajectory. The sovereign wealth fund hypothesis gains credibility when considering the dramatic shifts in global monetary policy since 2020. Central banks worldwide have printed over $25 trillion in new currency to combat pandemic disruptions and subsequent economic weakness, expanding money supplies at rates that would have been unthinkable a decade ago. Traditional reserve assets like government bonds now offer negative real returns after adjusting for inflation, pushing institutional investors towards alternatives that can't be debased through political decisions. Gold has seen renewed central bank buying, with purchases exceeding 1,000 tons annually in 2022 and 2023, the highest levels in over a decade. Silver, with its much smaller market capitalization and higher volatility, typically attracts less institutional attention. But for a forward-thinking sovereign fund concerned about monetary stability and seeking asymmetric returns, silver at current prices represents perhaps the most compelling value proposition in the entire precious metals complex. Several nations have compelling strategic reasons to accumulate silver quietly. China, the world's largest manufacturer of solar panels and electronics, consumes roughly 200 million ounces of silver annually for industrial purposes. Securing future supply at favorable prices would make enormous economic sense, particularly given rising geopolitical tensions that threaten global supply chains. The Russian central bank, facing unprecedented Western sanctions that froze its dollar and euro reserves, has dramatically increased gold holdings and might view silver as an additional monetary diversification. Middle Eastern sovereign funds, managing enormous oil wealth in an era of energy transition, increasingly recognize that the green technologies replacing fossil fuels require vast quantities of industrial metals, including silver for solar panels and electrical systems. Any of these actors could use $650 million as a modest initial position in a metal whose strategic importance far exceeds its current market valuation. The industrial buyer scenario presents equally compelling logic, but from a different angle entirely.
Major technology companies and automotive manufacturers have watched with growing alarm as various commodity markets experience supply disruptions over the past several years. Semiconductor shortages crippled auto production. Nickel prices briefly surged 250% in a single day when a short squeeze on the London Metal Exchange exposed insufficient physical stocks. Palladium and rhodium, critical for catalytic converters, saw prices quintuple as Russian supply came under sanction pressure. These experiences taught procurement officers that just-in-time inventory management and reliance on spot markets creates unacceptable vulnerability when supply tightens. Companies now increasingly sign long-term supply agreements or directly purchase physical inventories of critical materials to ensure production continuity. Silver, essential for solar manufacturing, electronics, and electric vehicle production, falls squarely into this category of materials too critical to leave to market forces. Tesla, which requires approximately half an ounce of silver per vehicle for electrical systems and plans to produce 5 million vehicles annually by 2030, would need 2.5 million ounces of silver yearly just for automotive production, not including their solar and battery storage divisions. First Solar, Longi, and other solar manufacturers collectively need over 140 million ounces annually, a figure projected to double by 2030 as solar adoption accelerates. If any of these companies decided to lock in 5 to 10 years of silver supply at current prices, a $650 million purchase would represent prudent supply chain management rather than market speculation. The fact that such a purchase remained anonymous could reflect competitive sensitivities. No company wants rivals knowing they're worried about future material availability, as it might signal production expansion plans or upcoming product launches. The third possibility, that an individual investor or family office orchestrated this accumulation, is perhaps the most intriguing because it suggests a bet not on industrial demand or monetary diversification, but on a fundamental repricing of silver relative to other assets. Several billionaire investors have publicly advocated for precious metals exposure, arguing that unprecedented monetary expansion must eventually trigger either severe inflation or a currency crisis that sends investors fleeing towards tangible assets. Stanley Druckenmiller, Ray Dalio, and Paul Tudor Jones have all discussed gold holdings in recent years, though silver receives less attention despite superior supply-demand fundamentals. A sophisticated investor recognizing silver's dual nature, both industrial commodity and monetary metal, might view current prices as offering the best risk-reward proposition in the entire investment landscape. The mathematics of silver's potential upside versus downside support this view. At roughly $25 per ounce, silver trades near its cost of production for many mines, creating a natural floor that limits downside risk absent a severe global recession. But the upside potential remains extraordinary if industrial demand continues growing while investment demand surges in response to monetary concerns. Silver's historical price ratio to gold has averaged roughly 60-to-1 over the past century, meaning 1 ounce of gold bought 60 ounces of silver. That ratio currently sits near 90-to-1, implying silver is dramatically undervalued relative to gold. If the ratio reverts to its historical mean while gold appreciates due to central bank buying and inflation concerns, silver could easily triple or quadruple from current levels. For a patient investor with deep pockets and a multi-year time horizon, accumulating physical metal at today's prices offers potentially asymmetric returns, limited downside with exponential upside if the thesis proves correct. The structural peculiarities of the silver market amplify this asymmetry. Unlike gold, where total above-ground stocks represent approximately 70 years of mine production, silver's available investment inventory has declined dramatically over decades of industrial consumption. Much of the silver ever mined now exists in microscopic quantities dispersed through landfills, impossible to recover economically. The readily available supply, metal held in bullion form in vaults and available for purchase, amounts to perhaps 3 billion ounces globally, or less than 4 years of current industrial demand. If even a small percentage of global investment capital decided to allocate to physical silver as a monetary hedge, available supply would evaporate rapidly, forcing prices dramatically higher to incentivize new mine production and substitution in industrial applications. A buyer accumulating $650 million in physical metal today might be positioning for exactly this scenario, acquiring supply before the broader market recognizes the scale of the coming shortage.
The implications of this mysterious $600 million accumulation extend far beyond the immediate transaction itself, revealing fundamental vulnerabilities in how modern commodity markets function and price discovery occurs. For decades, precious metals trading has operated on a peculiar fiction that paper contracts traded in enormous volumes on exchanges like the COMEX accurately reflect the supply and demand dynamics of physical metal that exists in finite quantities in vaults and refineries worldwide. This system functions smoothly as long as most market participants remained content with paper exposure, never demanding actual delivery of the underlying asset. But when sophisticated buyers begin insisting on physical possession, taking metal out of the pool available to back multiple paper claims, the entire structure becomes dangerously unstable. The $650 million purchase may represent not just one buyer's strategic positioning, but the opening move in a broader shift toward physical settlement that could fundamentally reshape precious metals markets. Evidence of this transition appears in multiple market indicators that veteran traders recognize as warning signals. Lease rates for silver, the cost of borrowing physical metal from bullion banks, have spiked intermittently to levels that indicate genuine tightness in available supply. Normally, lease rates hover near zero because ample metal sits idle in bank vaults, available for lending at minimal cost.
But when lease rates surge to 5%, 10%, or even higher, it signals that banks are struggling to source metal for delivery obligations, forced to pay premium rates to borrow from other holders. The New York and London premiums, the amount buyers pay above spot prices for immediate physical delivery, have similarly expanded beyond levels explainable by normal fabrication and logistics costs. These premiums represent the market's desperate attempt to allocate scarce physical supply among competing buyers, a rationing mechanism that emerges when demand exceeds immediately available inventory. The disconnect between paper prices and physical reality creates a powder keg situation that could detonate spectacularly if confidence in paper markets erodes further. Consider what happens if other large buyers, observing that someone successfully accumulated $650 million in physical silver without triggering proportionate price increases, decide to replicate this strategy. If even a handful of institutional investors or sovereign funds attempt to acquire similar quantities, the available floating supply would vanish within months. Refineries operating at capacity couldn't increase production quickly enough to meet surging demand. Mining companies, facing years-long development timelines for new projects, couldn't respond with additional supply. The only market clearing mechanism would be dramatically higher prices, high enough to destroy marginal industrial demand, incentivize recycling, and convince existing holders to sell. Some analysts suggest this repricing could send silver to $50, $75, or even $100 per ounce before equilibrium returns, levels that would generate headlines and trigger a rush of speculative buying that further exacerbates supply shortages. The historical precedent for such violent repricings exists in multiple commodities. Uranium, after trading in a narrow range between $20 and $30 per pound for nearly a decade, surged to $106 per pound in early 2024 when a combination of mine supply disruptions, reactor restarts, and strategic buying by financial sponsors created a squeeze. Palladium experienced a similar trajectory, rising from $500 to over $3,000 per ounce between 2016 and 2022 as automotive demand growth collided with concentrated supply from Russia and South Africa. Lithium prices increased tenfold between 2020 and 2022 before crashing when new supply flooded the market. Silver possesses characteristics that could produce an even more dramatic price move: tighter physical availability than uranium, broader industrial demand than palladium, and monetary characteristics that lithium lacks entirely. The mystery buyer's $650 million position could appreciate to $2 billion or more if silver undergoes the kind of supply-driven repricing that other critical materials have experienced recently. Yet the forces working to suppress silver prices and maintain the paper market fiction remain formidable. Bullion banks that have sold forward metal they may not possess face catastrophic losses if prices rise sharply and buyers demand physical delivery. These institutions wield enormous influence over market structure through their role as authorized participants in silver ETFs, their seats on exchange committees that set trading rules, and their relationships with regulators who oversee commodity markets. They possess powerful incentives to ensure that silver prices remain contained within ranges that don't trigger delivery crises or margin calls on short positions. The tools available to accomplish this include high-frequency trading algorithms that can overwhelm human buyers, strategic deployment of large sell orders during thinly traded sessions, and the ability to settle delivery obligations in cash rather than metal when supply proves insufficient. The mystery buyer's success in accumulating physical silver without triggering defensive responses from these entities suggests either extraordinary operational security or tacit acceptance that physical demand has reached levels that can no longer be fully suppressed. The broader context of this accumulation includes accelerating de-dollarization efforts by nations concerned about currency weaponization and declining confidence in fiat monetary systems. The BRICS nations, Brazil, Russia, India, China, and South Africa, have discussed creating alternative payment systems backed by commodities rather than sovereign promises. Gold features prominently in these discussions, but silver's industrial utility and historical monetary role make it equally relevant for a commodity-backed currency system. If even a fraction of the $13 trillion in global foreign exchange reserves shifted toward tangible assets including silver, the available supply would prove grotesquely insufficient at current prices. The mystery buyer might be positioning ahead of this structural shift, accumulating metal before official sector demand overwhelms the market's ability to deliver physical quantities at paper prices. The identity of this buyer ultimately matters less than what their actions reveal about the profound disconnect between perceived and actual silver availability. Markets function efficiently only when prices accurately reflect supply and demand fundamentals. When paper trading dominates price discovery while physical supply tightens, the result is inevitable repricing, either gradual as market participants slowly recognize the imbalance, or violent when a triggering event suddenly exposes the fiction underlying current valuations. The $650 million accumulation, whether executed by a sovereign fund securing monetary reserves, an industrial giant locking in critical supply, or a prescient investor positioning for monetary chaos, represents a vote of no confidence in the sustainability of current market structure. It signals that at least one sophisticated actor believes physical silver at today's prices offers compelling value that won't persist once the broader market awakens to the reality of constrained supply meeting inexorably growing demand. The endgame for this market configuration can only resolve in limited ways. Either new mine supply emerges rapidly enough to satisfy both industrial and investment demand at current price levels, a scenario that geological realities and project development timelines make nearly impossible, or prices must rise dramatically to ration available supply among competing uses. Industrial applications will bid aggressively for silver they need to maintain production, investment demand will surge if prices begin appreciating and attract momentum buyers, and existing holders will require significant price increases before parting with metal they've accumulated precisely because they doubted paper market valuations. The mystery buyer holding $650 million in physical silver sits positioned to profit enormously from this inevitable adjustment. Having acquired supply while the market remains and hypnotized by paper trading volumes that bore no relationship to physical reality. Their accumulation may be remembered as either prescient preparation for the silver shortage that reshaped commodity markets in the late 2020s, or as the final warning signal that went unheeded before the repricing began.